All right, well, it has been a roller coaster week for markets as big tech earnings passed a crucial test. We've seen stocks reacting more than usual to earnings announcements this time around. Markets are poised to end the week higher thanks to AI-fueled rallies from Microsoft and from Alphabet. So where do we go from here? We want to bring in Nicole Inui, HSBC's head of equity strategy for the Americas. Nicole, it's great to see you here. So talk to me just about your reaction to the earnings prints that we've gotten up until this point and whether or not it's enough for the market to continue here to move to the upside.
Yeah, great. Thank you for having me on. Earnings have come in actually much stronger than expected. So looking at the percentage of earnings beats, about 75% of companies that have reported so far have beat earnings, but the price reaction hasn't been so great. So if a company misses, yes, you're seeing those companies punished, but companies that are beating, you're not seeing necessarily that increase in the share price that you would typically see. And we think this is because investors are scrutinizing even more earnings and forward guidance. So if you look into the second half of the year, you actually see earnings expectations are pretty high. So when we see companies reporting earnings, it's not so much what they're reporting in the quarter, but what they're saying for the second half of the year. And I think the market really is expecting that guidance is actually better than what they've already priced in right now. So that's the reason why the reaction hasn't been as strong for many of these names as we've seen in the past.
So then, Nicole, what does that signal then for the current quarter that we're in right now and also the second half of the year? If we have these low expectations like you are setting, or that like you are saying, it's setting the stage for some beats, is that going to be enough then going forward?
No, I think so. We're still very constructive U.S. equities. We have a price target of 4,500 for the S&P for the end of the year. I think first quarter near-term expectations are very low, so that does set a very low bar for an earnings beat. And we have to remember what we're seeing on the GDP growth side. And I think we keep forgetting that 6 months ago, the market was expecting that the U.S. would grow less than 1% in 2024. Now we're at 2.4%. So that is very supportive for earnings growth over the second half of the year. So yes, expectations are on the high side, but we think with this GDP growth that we expect to stay resilient, we think that companies can deliver on that earnings growth expectation over the next few quarters.
Nicole, one thing you haven't mentioned yet is the Fed and whether or not the Fed is going to cut, how that's factoring into your projections. Does it matter at this point whether or not we get 25, 50 basis point cut before the end of the year?
I don't think it matters when we get the cuts. I think it matters that narrative still needs to be in place. So, the inflation data that we saw today is in line with what we were expecting. But what it's showing is that inflation is staying very sticky. What we don't want to see is a reacceleration in inflation. We think if we get that, then we start seeing this narrative shift from not when the Fed will cut, but if the Fed will hike. So as long as we're in this continued narrative that the Fed will eventually cut, it doesn't matter if it's June, July, September, December, as long as that narrative is in place, we think that is still very supportive for equity markets.
Nicole, you said if the Fed will hike. It doesn't sound like you think it's too likely at this point, but what is your expectation when it comes to that? And obviously the potential implications then for the broader market.
Well, I mean, we do have a bear case scenario of the S&P reaching 4,800 at the end of the year, and that is a no Fed cut scenario, and this narrative shift from, the Fed's not going to cut, but the Fed will hike. And if we see that, obviously that is a headwind for valuations. It's a headwind for earnings, as you see corporates will actually probably have cost pressures if that inflation moves a little bit higher. So that is really kind of the downside scenario that we have for the S&P, the no Fed cut, and actually the market's starting to price in a Fed hike. We still feel like we're pretty far away from that right now, looking at the data that we've seen recently.
Nicole, talk to us then about your strategy, where you're seeing opportunity, how you are positioned then heading into the second half of the year.
Right. So, we're still very positive big tech. We think it doesn't really matter if rates stay high for longer for tech. These companies, a lot of them have very strong balance sheets. They're net cash. So if we do see rates staying higher for longer, we don't see that having an impact on the balance sheet. And also, they're delivering on earnings. This is a secular growth story, so we think that sector continues to stay strong over the second half of the year. Another sector we like is consumer discretionary, and this really, we're taking kind of this barbell approach where we like companies that are focused on the high-end consumer. We think the high-end consumer will continue to do well even if rates stay higher for longer. They have these fixed rate mortgages. They have the wealth effects from higher home prices and higher equity prices. So we think stocks focused on that sort of sector will do well. And as well, in the low income sector, you could see this trade down of the middle income consumer trading down, which could help some of those companies that are really focused on the lower end consumer as well.
All right, Nicole Inui, great to get your insight. Thanks so much for hopping on with us this morning. HSBC's head of equity strategy for the Americas. Thanks so much.